Welcome to week 6, module 1, valuations. And for the second straight week, we showed money, right? And I guess money is the name of the game. There's a TV show I watch almost every day called Money, and I think it's probably by far the most important for many people, especially when we're talking about the proceeds from an estate. So let's get into it right away. What is valuation planning? Techniques used to affect the valuations of assets for purpose of reducing taxes. This is kind of relatively new. When I first got involved in estate planning, we never really worried a lot about valuations of assets. We did worry always about taxes, and taxes were much higher than they are today, but the valuation planning was never a big deal. It was sort of an offshoot. Some people did it more than others. Typically, if a CPA was involved, it was included. If it's just lawyers, less likely. But today, I think all the financial planning team, which of estate planners, does take it into account, because on the team today, we have the lawyers, we have the accountants, we got the bankers, we got the insurance, everybody in the group trying to help the client. Factors affecting value, there's 3 of them. First of all, the frequency of the sales, relationship between the buyer and seller, and the offers to purchase of sale. Again, these are what the IRS is looking at, and when we talk about valuation, to ignore the IRS is ridiculous, because they will be questioning almost anything in your estate tax return, because again, every estate tax return is audited. It's either going to be audited back in Cincinnati, or it's going to be audited at your office. Every piece of assets are going to have the valuation and how you came up with that valuation, which is typically going to be by appraisals. And these are the 3 things that the IRS really looks at for looking at the valuation. Determinations of value. There can be multiple markets for a product. For example, if I have an orange here in my backyard, I have an orange tree, and for me, oranges, I don't really buy them. I have a tree to take care of my needs for at least 6 months of the year. But if I was in Alaska, that market for that orange might be entirely different. Or if I was down in downtown Los Angeles or downtown Chicago, big difference for oranges. So depending on the demand for the item, it's going to determine what the market is. And we can expect the values to be different. So therefore, when I have an appraisal made and the appraiser takes a sale of something in New York State and applies it here in California, which is pretty good for appraisals, it isn't going to be very satisfactory for the IRS. They would like to know what's happening here. The appraisal of the worth is how much is valued. Again, this is done by professional appraisers. And I might know at this stage there's 2 types of appraisers, and you got to keep them separate. One are insurance appraisers, which tend to overstate the value of an appraisal, and then the appraisers for IRS, which tend to try and keep it low. Now, what keeps the appraiser from having real low numbers? Well, if the IRS finds that the appraisal of an appraiser is not being in what they consider a range of reasonableness, they take them off the list of who can appraise for them. So there's a fine line that the appraiser has to go to if they're going to do IRS work. From your standpoint, you should make sure that the appraiser you hire is actually one who does IRS work, not life insurance work. I mean, I'm sorry, not insurance appraisers, because quite honestly, you don't want the big values at death. You want lower values. And then finally, the last thing the IRS is looking for is how unique that asset is. The more unique it is, usually the more valuable. Life insurance valuation. Again, this is the IRS material. New policy is a gross premium. It's the fair market value that they'll use. If it's a paid-up policy, the replacement cost is the value, and again, that's the fair market value. The whole life policy is interpolated terminal reserve, the fair market value, and the term policy use of the unused premiums is the value. In other words, put it in all situations, life insurance had its fair market value, and the source is the insurance companies. And the IRS uses the insurance company information. And I had a student a couple of years ago say, well, what if we have 3 insurance policies, all the same, and they were all interpreted differently by the 3 insurance companies? What would the IRS do? So I contacted a friend of mine who, although doesn't do estate taxes, he was very familiar with what the IRS approaches are to things, and he said they would go with the value of each of the insurance companies. Again, as long as they were American recognized insurance companies. Government bonds, Series E bonds, are valued at the redemption price as of date of death. That you probably ask, why did I mention Series E bonds? Because it's been on the CFP exam several times, and therefore it's on here. Commercial annuities, they're valued by reference to the price at which the company issues comparable contracts. Again, the IRS takes the information that's provided by the annuity company or the insurance company to come up with what is a fair price. And so there really shouldn't be any disagreement between you and the government. Future payments, the future value of future payments is determined its fair market value for estate and gift taxation. And the present value is determined by use of the IRS rates. IRS has a series of rates that are used throughout various aspects of doing business with the IRS, and everything from present value of an annuity to present value if you have a gift that you're giving to a family member, etc. So you have to look up the right rate table, but that will give you the interest rates to use. Securities, the fair market value listed security in the bond is based on the selling price when there is a market for it, and you use the date of death for the value. A large box of stock is sold with the depressed market price, therefore they make an adjustment for that, and that to reduce the price to reflect the fact that there will be a depressed value. For example, when Steve Jobs died, if he had a lot of Apple stock, which I assume he did, and his estate, when it's going to be filled out, will probably have a depressed price for the market value of Apple stock due to the fact that it was a large block. Controlling interest in a concern has an increase in value due to the fact of being in control. And this is one of the things I don't see many financial preparers of estate taxes address. If there's a controlling interest, you kind of ignore the premium, where if it's a minority interest, they always include the discount because it's a minority. But the IRS doesn't forget. The IRS seems to always remember, well, it's a controlling interest here, therefore there's going to be an increase in the value due to control. So we'll just take a company worth $1 million. 80% of it is owned by one individual, which says, in theory, it would be $800,000. The IRS would probably go with $900,000 as being the value. Corporate bonds, the same rules as for listed stocks. Valuation of closely held corporations, situations where estate planners must value the closely held businesses. And again, a lot of this information continues to be from the IRS because that's who you're dealing with. The times when you have to have a valuation, first of all, when you're planning for the liquidity of the estate, you're going to need to buy insurance or find other ways to pay for the taxes. That's going to mean that you're going to have to get a value. When you're establishing a buy-seller price, you're going to have a value. When you're valuing the price business for a prenuptial agreement, you're going to have a value. Apportionment and marital dissolution, there's going to be a value. Ascertainable value for a loan, estate tax valuations, and then I'll say fiscal checkups. How often should a fiscal checkup be? Well, again, it depends on the situation. If it's a stable situation and taxes aren't changing and the assets aren't changing and family lifestyle isn't changing, you probably don't have to do a fiscal checkup more than every 3 or 5 years. But I know other people which have a volatile lifestyle. They've changed their assets quite often. There's a little bit of turbulence in their marriage. I would suggest the fiscal checkups be more often, maybe even as much as every 6 months. I would say for the average person, every couple of years it's common. Factors in valuing a business, again, this is going back to the IRS. Nature and history of the business is a factor in how it's valued. A new business isn't valued as valuable as a business that's been around a while and constantly growing and constantly increasing its profit. The economic outlook, both systemic and unsystemic. So we look at, for the systemic, what the economy is doing, and for the unsystemic, those things that are related to this particular business. We'd also look at maybe the interest rates that this particular industry has to go through and the location of where that business is. Book value and financial conditions of companies are going to be reviewed, as well as the earning capacity. That isn't the earnings, it's the earnings capacity. Many times earnings are kept down in order to keep the taxes down. The IRS is aware of it, so they will look at what the capacity is, not what you're declaring. Dividend paying capacity, the goodwill value, which is the difference between the asset value and the selling price. Sale of stock and size of block value. And then finally, market price of stock of similar companies. And that's probably the most important. If it really gets down to issues, what are other similar companies selling for in this area under today's conditions? Planning in closely held businesses, we have a present transfer of interest to younger generations, and that's done on a continuous basis over a period of time, results in the transfer of the business from the senior members of the family to junior members, and that's done typically under estate freezes or family trust, which we'll be discussing in the future in this session. Shift of future growth to younger generation, and again, not just transfer the interest, but the growth potential, because again, we would like to have the estate being about the same size it is today or close to it, or even less, for purposes of estate tax, using the unified credit and the generation skipping tax exemptions through annual transfers of interest to the younger generation. And finally, use the discount for lack of marketability and for more minority interest. There's all sorts of different opinions that I've seen in writing regarding lack of marketability and discount for minority interest. It is very subjective, and I've seen people say, well, you can get a 40% discount. I've seen other people say you get a 20% discount. A lot of it, I think, has to do with how much the IRS thinks the value really is, and that is a subjective nature. I would say if you tend to understate the value of the assets, the IRS will be more reluctant to to accept your discounts, where if you try to be reasonable and more apt, they'll accept it. But again, there's a lot of judgment in the area and a lot of negotiations, and I would say that negotiation skills are very important for the people who are discussing this with the IRS. Now, when we have intra-family business transactions, there's certain things that the IRS are looking for, and it says agreement to predetermined valuation at death. And this is something that I have been involved with many times. We have a business or we have an asset that's very hard to value. So it could be an artwork, could be a patent, whatever. And the agreement must, first of all, be a bona fide business transaction. In other words, it's treated between the sale of the family member to the other family member, or for purposes of estate tax, treated as a business transaction. It cannot result in lowering the value from a full and adequate consideration. In other words, it must be treated as if it's an arm's length transaction. And it's a formula that's used, not the dollar value. So if let's say you have a small business and it happens to be a small ethnic grocery store, which I just recently had a situation on, we look at how those are valued for purposes of sales in the industry. So you go to someone who's a biz op in your area and get their opinion and use that, and then provide the information you get from them to give to the IRS, and you come up with an agreement that's agreed to by the IRS. This is called a letter ruling, and it's very helpful because it does away with all of the disagreements of death. It allows you to come up with the amount of insurance money you need for the transaction, and you're allowed to do a lot of planning for a very nominal cost of getting the agreement with the IRS. And again, the IRS is locked into the agreement. Whether it goes up or down, both parties are locked in. Examples in intra-family discounts are fractional interest discount, minority interest, lack of marketability, and lock-in discount. These are all in the textbook. There's also a contractual discount that is covered, I believe, in your textbook. These are the most popular of the four. You're going to see these a lot more than the others. It seems every attorney tries to come up with another interest that they can use as a discount. With that, we're done with Module 1, and we're going to hopefully you can get to Module 2 relatively quick because all of this information, again, is related. And you have questions, I think if you can go over the material again, also look at your textbook, you're going to find the answers you have. Stuff is not as complicated as you might look at the first